Hello and welcome back to All Things Money. I'm your host David Blain. During this segment we're going to talk a little bit about taxes, some of the tax law changes coming up, some things that are expiring. It's practically a full-time job just trying to keep up with the tax law changes. I went to our annual tax update seminar where we learn about new laws that are coming up and things that are expiring and things that are phasing in and phasing out, and it is just unbelievable trying to keep up with the changes that they make. I think whether you think people need to pay more or less tax, I think there's some common ground on all sides of the political spectrum that the tax code needs to be much simplified. But what generally happens is it needs to be simplified for the other guy, and everybody wants to retain their own individual little perk deductions. But we have got to have some tax reform coming up. So let's talk about a little bit of the changes that are coming out. The 2010 Tax Act that was passed in 2010 extended the Bush tax cuts for 2 years. So the 10, 15, 25, 28, 33, and 35% are supposed to continue through 2012. But in 2013, they will go back to 15, 28, 31, 36, and 39.6. So if you're doing your tax planning and you think that that they're not going to change anything by 2013, next year may be, in fact, the end of these low rates that we've seen. And they're going to go up for everybody. I mean, the 10% tax bracket, the lowest bracket now is 10. It's going to 15. I mean, that's a 50% increase for the lowest tax bracket. Okay, so the income tax rates for 2012, 35% goes up to $388,000, $350,000. If you missed the last segment, that would be the average compensation of our college professors. This is interesting, trust and estates. For those of you looking at trusts and estates, you may not know it, but the maximum trust rate starts to kick in at $11,650. So it's when you're doing your tax planning or estate planning or things like that and thinking about setting up trusts, keep in mind that you don't want that trust to retain that. Well, maybe you do, but if that trust retains that income and does not pass it through the beneficiaries, it reaches its maximum rate at only $11,000 of income. It's quite an onerous tax for trusts that retain their income and do not pass it out to the beneficiaries. So the kiddie tax applies to children under 18 as of 2008, or full-time students age 19 to 23, and more than $1,900 of income is taxed at the parental rate. Many of you don't know that. Let me read that again. If children are under 18 or age 19 to 23, unearned income such as dividends, interest, things like that are taxed at the parent's rate. Dividend and capital gains taxes are, if you are in the 10 or 15% tax bracket, they're still 0%. And yes, that is 0% capital gains rate. A lot of people don't realize this, that once again, it's just not the wealthy. If you're in the 10 or 15% tax bracket, your capital gains and dividend are taxed at 0%. It's quite a nice tax break. The standard deduction for 2012 will be $11,500. The phase out on itemized deductions disappeared last year and will continue through 2012. The personal exemption will be $3,800, and the phase out on personal exemptions also disappeared. So two big ones, the phase out on itemized deduction and the phase out of personal exemptions will still not be in place for 2012. Talk a little bit about contributions. IRAs still stay at $5,000 limit per year. If you're over 50, you can add another $1,000 to that. Roth IRAs, the same thing, $5,000. If you're over 50, it goes to $1,000. But you can't contribute to a Roth. The contribution phases out between $173,000 and $183,000 for married taxpayers and $110,000 to $125,000 for single taxpayers. For those of you lucky that have a 401k out there, the 401k cap moves up to $17,000 for 2012, up from $16,500, and the catch-up contribution for those 50 and over is $5,500. So that's a total of $22,500 that you can defer from your salary into a 401k. Now, okay, I realize that you need to at least make that amount, but if you do have a decent income, a high income, and you have a 401k and you can put that type of money away, especially if there's a match, it's generally a good idea. There's also something called a solo 401k. If you have a small business with no employees or just you and your spouse, the solo 401k is a great way to put a lot of money away. We have several clients that have businesses that they are the owner and the spouse and the husband has another job. We're able to put the entire salary of that spouse into a 401k, tax deferred, and as a tax deduction. It's just a great vehicle. So for the estate and gift taxes for 2012, those of you that are giving money away, the exclusion is still $13,000 per donee. Of course, $26,000 if the spouse joins in the gift. The estate and gift tax exclusion is $5 million for 2011 and 2012, and then starts to get indexed for inflation. So, for example, in 2012, let me make sure I'm reading this right. In 2012, it will move up to $5.12 million. The 35% estate and gift tax rate continues through 2012. We also had the legislation that was passed that allows a spouse to use their $5 million and to pass it on to their spouse. So as a couple, you can now shield $10 million from estate and gift tax. Now, a lot of people think this is going to be a target in the future, that Congress will reduce that. You know, I don't know. It seems to me it would be kind of hard to go backwards, especially when you've been allowing people to give away as gifts that much money. They're kind of tied together. The tax-free distributions from the IRA, unfortunately, is ending in 2012. Well, there's a lot more tax updates. We just scratched the surface, but we'll have to get to that next week. That's all the time we have for now. So for All Things Money, I'm your host, David Blain. I hope you will join us again next week at the same time.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.